You're listening to The Real Well Show with Kathy Fettke, the real estate investor's resource.
How do you find a trustworthy financial planner? And if you're really into real estate, how do you find a financial planner who understands your strategy and supports it and can help you with it? I'm Kathy Fettke, and welcome to The Real Well Show. Our guest today is just that. Kyle Mast is a financial planner, and he's also a real estate investor. He's a CFP and the owner of Clarity Financial, but I just want to warn you, he is not taking new clients at this time. But he's happy to give us guidance here on The Real Well Show for free. So Kyle, welcome to The Real Well Show.
Thanks for having me, Kathy.
So do you agree that it's important for your financial planner to understand real estate if you are also investing in real estate?
Well, it's a very loaded question. Yes, very easy question. Yeah. If you're not interested in real estate at all, then you probably don't need a planner that knows very much about it. But yeah, if that's a big piece of your portfolio, especially if it's the majority of your portfolio, you need to make sure your financial planner, and depending on what you mean by financial planner, does understand real estate just as much as maybe stocks and bonds or something that's maybe more typically thought of in that area.
I'm so glad you mentioned that because I thought, a financial planner technically should be someone who looks at your entire financial plan that would include real estate, but generally it doesn't at all, right? It's just mainly for stocks.
Yeah, it depends on who, when you go to look for a financial advisor or a financial planner, there's a couple things that you maybe want to look for when you're looking to work with someone. Some people are very focused on investment management, getting a portfolio of investments that include stocks and bonds, maybe some alternatives in there that could include real estate. But sadly, our industry, a lot of the training is really focused on stocks and a portfolio and how to allocate it according to someone's age. And those things are all important, but it misses, a broader picture of, if you own a primary residence, should you consider refinancing at some point? And a lot of times the incentives maybe aren't aligned when you work with a financial advisor. If you want to pay off your house, that's less money for a financial advisor to manage and make fees on. And that doesn't mean that a good financial advisor or planner can't overlook that conflict of interest and give you good advice one way or the other, depending on your situation. But those are things you have to be aware of. If they're getting paid on a certain product or investment, that's a conflict of interest that kind of dictates how they may offer you advice.
Sure, always follow the money, right? That's the problem is we don't know often how to follow the money. I was a mortgage broker for so long, and back when I started, you didn't really even have to disclose how much you were making. It was just back end commissions that would be made, sometimes 3%, of a $1 million loan in California, 30 grand to push some paper, but the client really never even knew that we were making that much. So is it the same with financial planning? Is there kind of secret fees behind the scenes?
Yeah, there's different. Maybe I'll try to use an illustration to kind of give people an idea. When you're looking for a financial planner, I'm what's called a fee-only fiduciary. So I'm a certified financial planner, but I'm also a fee-only. So that means I don't earn commission for selling an investment product. I earn fees from the clients, either that if that's for managing something for them, whether it's a portfolio of investments, or a lot of the times it's an hourly fee for just advice, or an annual retainer fee is actually what I do with a lot of my clients. And that type of model is kind of like, I maybe liken it to if you were going to shop for a car and you went to Kathy's fiduciary car advising, and you don't work for Toyota, you don't work for Honda, Ford, any of these companies. Someone comes to you and pays you $300 and says, I have a family of 4. What's the best minivan I should buy? That you have no dog in the hunt. You're making your fee for giving the advice, and you could send them to the Toyota Sienna. I'm talking about minivans. We just had twins, so these minivans are on my mind. But you'll send them wherever is best for that person. That's a fee-only advisor or a fee-only financial planner. If you think about say a Toyota dealership, if you go into there and you say, what's the best car that I should buy for my family? They're not going to send you to the Honda Odyssey.
Right.
Makes sense. They work there. They know their cars really well. There's nothing wrong with that. It's just something that you need to keep in mind. So in the financial world, there are advisors that may work for a larger company. I won't mention company names, but larger companies that have proprietary products or investments that a financial advisor may earn a little bit more, or a commission, or be incentivized in some other way, like with trips or things like that, to sell a product into a portfolio. And there's nothing wrong with that. I know a lot of really good advisors and good planners that are in that model of the industry, but that's a conflict of interest that you just need to be aware of when you're going to work with someone. So if you're looking for someone and you want complete objectivity and you want as little conflict of interest as possible, you want to look for someone that's fee only and that is going to charge you an hourly rate or even an annual retainer. And a lot of times people don't want to pay for that. An hourly rate might be, for a really good one, it's going to probably be closer to the $400 an hour range. That's probably the highest end. You might even get higher than that. For one that does a retainer on someone who has a larger portfolio of real estate or investments, depending on what you have going on, it may be, you could pay $10,000 a year and even more. But then there's others. If your situation is not as complicated, it might be worth just paying for an hour of time of a financial planner. If you pay $400 and they give you advice on some tax planning situation and a portfolio allocation that saves you $20,000 every year for the next 30 years, it's not a bad investment. So that's kind of the model if people are looking for something completely objective. And if you currently have a financial advisor, that's something to maybe do a little bit of research and see what their model is. A lot of people don't know how they pay their financial advisor. That's the first question to ask, how they get paid, and they should be able to answer it, no problem. And they should get paid, and they should get paid well if they do a good job. But you as a customer or client deserve to know how that's happening.
Which are the highest paid commission investments? In other words, the ones that financial planner might be most, might benefit the most from putting you into?
That's a very good question. So it changes over the years. And thankfully, there's more regulation than there used to be on some of this stuff. So that it does have, like you were talking about the mortgage industry, things have to be disclosed more. Some of the higher commission products these days would be things like variable annuities, which is like a insurance investment product hybrid, to really kind of simplify it. And that doesn't mean it's a bad product. It means that there's a certain incentive there. And there are situations where that makes sense to have a product like that. Life insurance, some insurance sales. That's a part of the industry that there really isn't a non-commission product out there. It's pretty much anytime you buy life insurance, there's going to be some sort of commission. Some financial advisors, and I have to be careful. I hesitate to call them advisors sometimes. If you're just I would say an insurance advisor. If someone is just an insurance salesman, they know a lot about insurance.
It's a salesman, yeah, not an advisor.
Yes,
it's a salesman.
yes. Yeah. But they know a lot about insurance, and I refer clients to an insurance advisor or salesman to advise them on what insurance they should get, and then bring it back to me so that I can look over it and make sure there was no incentive or, whole life insurance has a very high commission.
Yes.
It's a very high commission product. There's a place for that. For most people, it does not fit. For higher net worth people, it can fit in certain areas.
How high net worth? I'm curious.
Oh, this is another, it depends. I would say, 5 million and above of net worth, you could probably make a pretty good case for it. Below that, there's definitely, you can make cases for it. I shouldn't even put a number out there, but that's probably that popped into my mind.
Okay. Well, I'm just curious because we got calls all the time from people wanting us to promote it, and I didn't understand it enough, so I didn't want to do it. But I just knew that there were huge commissions, and I didn't really understand the benefit, but I keep hearing how great it is, but I'm not sure if that's coming from the salespeople or from the client.
Well, to go into a little more detail in the real estate arena, your listeners, there's a little bit more benefit to a whole life insurance product if it's structured correctly. And the reason for that is if it's someone with higher net worth or higher income and higher income bracket, it allows you to access funds tax-free by taking loans on an insurance product. And it's too much detail to go into on this podcast, but there is more of a case to be made there, but you do have to understand it. And it is not easy to understand. And a lot of times that starts to get even higher net worth, like you get to where you're really structuring a whole strategy around there's like an infinite banking concept out there that several people are proponents of. And it's a very good thing for someone who has very high net worth and they're building a team. They have a financial planner, a CPA, an insurance expert, an attorney. It's kind of this family office type setup where you're really building out something that is a generational thing and your taxes are just eating you alive, then you add this product in. But, for the average higher net worth person from the 1 to 5 million range, I would say it's the minority that you would need a product like that, because you can get
Wow.
the insurance.
Okay.
If you're looking for life insurance, term insurance, which means you pay for it every year for a certain number of years, either it's 20 or 30 years. You get $1 million policy. Like for me, $1 million policy, guy in the 30s, it's $60 a month. And after 30 years, it's done. I don't get any money back, but if I die, my family gets, it gets $1 million. You can invest that, put in real estate, whatever, is to take care of your family. It's not an investment product. It's not meant to be a cash management product. For the most part, that's going to be the best bang for the buck. And those extra dollars that you would have paid for a whole life product or strategy can be used to pay down debt or to pay the mortgage on a rental property, invest in some other way. Dave Ramsey often pushes the buy term, invest the difference. That's kind of, as opposed to whole life. It's not quite that simple, but for most people, that's probably a good fit.
Yeah. Yeah. No, I just figured that it was circulating among regular folks, and that probably the people benefiting the most were selling. But, everybody's got to make a living, right?
Oh, yeah, definitely.
Okay. So I find it fascinating to meet someone like you, because I was just talking to Rich thinking this is what we need. We need that person who can look at everything we're doing and let us know if we've got the right insurance, or we've got, maybe we're not diversified enough. We're definitely not diversified enough. We're barely in the stock market. We played a little bit when it tanked last year, but not my expertise. So we just, didn't want to put too much into it. Have a little bit in gold. I don't know if that's a good thing, but to have a service like that where somebody is just being paid by the hour, it sounds amazing. I know that I want to preface this with letting our audience know that you are retired. You are not taking, I think you're retired, or you're not taking new clients. So let's just get that clear. You're not promoting yourself. But how does someone find someone like you who is taking clients?
Yeah, that's a good question. Yeah, I'm not officially retired. I guess I could if I enjoy my job a lot. I've really dialed it back. Like I said, we have twins that are here now, and so family is really important to me. And and financial independence is a big thing for me too. But yeah, to find somebody that is kind of that hourly model. There's a couple of organizations out there. I'll throw those out there. That's actually probably a good place for listeners to head to. One is the XY Planning Network, it's called. I'm a member of the organization. It's like a professional organization that we do continuing education through, but it's only fee-only certified financial planners. So there's no commission product. Financial planners a part of that organization. And they have a website, and you can search for someone by geography. You can search for someone by expertise. So if you want someone who's real estate focused, it's a very good place to go for that. The other organization is NAPFA, NAPFA, the National Association of Personal Financial Advisors. And that's also a fee-only certified financial planner, CFP only organization. And it's a similar place to go to find someone that works on that model. What you will find is you will find people in any industry, people that have less experience. They might still be really good at their job. There's people that have less experience than me that are way smarter than me and do a way better job than I do, for sure. But what you'll find is the people that have 5 to 10 years of experience, it's going to be more like me. At least in this industry, there's such a demand for the fee-only financial planner that has the 10 years of experience already that a lot of us are very busy, or we've really dialed it back to not be taking on clients or take on people that we just really like. And that's, it's less about growing the business anymore, as opposed to like working with people that we can really provide value to. So those would be the good places to start. And, if you go to either one of those websites, they'll have a description of kind of what that person looks like. But I should say, your certified financial planner, not every financial advisor out there has that credential. There's CPAs, you have these other professional designations out there, and that certified financial planner, it's let's see, when I took it, it was a 7 separate exams that you have to pass, and then a 10-hour, 2-day exam that you have to pass.
Wow.
And you have to have 3 years of experience to hold the credential that you have to do under another CFP. And those requirements might have changed just slightly currently, but that's kind of what you're looking at. And the work is in insurance, estate planning, investments. There's several other different courses that you have to go through, but that's the person that you're wanting to look for, someone that's looking at everything. And then honestly, if you're talking to somebody, like you started off right at the beginning, to find someone that, if you're very real estate focused, you don't want someone that says, sell all your real estate and put it into Tesla. That's just this doesn't make sense. And you also want a CFP. If you think of a CFP kind of as the quarterback of a football team, there's a wide receiver that knows his job and is way better at it than the quarterback, but the quarterback knows about what he's supposed to be doing. So if he's doing something out of line, so like if I refer to an attorney for estate planning and I see something that's not quite right, I'm not an attorney and I can't give specific legal advice, but I can at least tell the client, you need to get another opinion. This is incorrect. Right. So that's kind of how a financial planner works. It's that broad stroke over the entire situation. And if you're more real estate focused, so where I was going with that is if the tax implications, a lot of financial advisors don't even look at, if you're starting to draw income in retirement, you need to look where you're going to draw it from. Do you draw from capital gains with a lower tax bracket? Do you draw rental income? Do you get a home equity line of credit to do income for 1 year because your taxes are too high and then you pay it off next year? Like there's all these little pieces. And when do you take Social Security? So, and they all balance each other out. Whereas if you have someone who's just investments or someone that's just insurance, they can give really good advice in those areas, but they've got to meet together. Or like if you're getting a 10% return in one investment, but your taxes are hitting you at 45% because you took it out of the wrong account or in the wrong strategy, you're really negating a lot of the value that's provided there. So does that kind of answer the question?
Yeah, it does. I'm wondering when we're going to get an AI that we can just put everything in and it spits out what we need to do. Then the government would get involved and not give you this tax benefit.
That's right. Yeah. Yes. Yeah. The problem is people don't fit into a box good enough for AI. If we were all robots, then I think they could create an AI for it. But each client, I have a client that he's losing his job, but they saved really well for retirement, and he's going to be retiring next month. But his situation is way different. He's able to do that because his living expenses were really low. I have another client that's a very similar situation, and it's going to be tough for them because their strategy could be the same if their lifestyle was different. So everybody, you'd really have to have someone that really wants to look at your whole situation and make recommendations specific to you and your family, the goals that you have. Do you have kids? Do you not have kids? Are you going to get inheritance at some point? Do you have goals? Ooh,
right. Good. You got to start there.
Yeah. I shouldn't assume that. Yes.
Some people a lot of people haven't sat down, or you have to keep revisiting them because life changes. And that's something that you would want to do, ideally with a coach or an advisor. So I'm curious why a financial planner would choose one over the other. It seems like you would make more money, and maybe it's the same thing, but in a situation where it's assets under management or commissions or both versus just a flat fee.
Yeah. Well, so I'll be very transparent in how I operate my business. So I do a lot of assets under management, and I also do like one-time fee only, like hourly stuff, and then retainer, where you charge a certain amount a year and the client has access to you. Initially, to get into the industry, it's a lot easier to do commission products. You can sell a product. It's like you said, everyone needs to make a living. And I want to make sure that we're not, sometimes I tend to talk down on that type of the industry. And I really need to be careful not to, because these are good people that are trying to make a living and really believe in the product that they're selling. They're just not looking at the whole picture sometimes. So that usually early on in a career, that type of commission product makes more sense, because if you're doing assets under management, if you're selling a product, $100,000 product, and you make a 5% commission on it, you make $5,000 just like that. If you're going to manage assets for a client, say you're advising them on real estate and investments, and it's $100,000 worth, but you're going to charge 1%, which is maybe an industry standard. That's $1,000 a year for 5 years that you have to wait to get that 5,000 if you would have just sold them a product. So that's the temptation. It's a delayed gratification type of business. And, the first 2 years that I started my firm, I bought a few little clients from an old firm and started my firm. I made $13,000 the first year and $19,000 the next year. Super small, but I was building a model of retainer clients only, like a long-term. So that's why an advisor might choose one or the other. Apart from the objectivity, I chose this model because I want to make sure that my conflicts of interest are as clean as possible for clients, and that they know that when they're coming to me too.
Yeah, I'm sure. Yeah, it makes sense. I mean, it's the same for me at Real Wealth. I could be selling $5 million homes in Malibu, but that's just not where my heart's at. I want to help the average person build, a portfolio of $100,000 homes that pay us barely anything, but
yes. Thank you for doing that. Thank you for not selling this and doing the Real Wealth instead. I appreciate that. Yeah. For everyone listening, I have a couple homes that I'm going through in Florida through the Real Wealth. I was telling Kathy before we got on that I wish I would have found them earlier, because I tried to do some of my own betting ahead of time in a market, and it's working out, but it was a lot of work, and it's been nice to work with the team.
That means so much. And I was so surprised when you said that in our pre-interview. I had no idea. I should have known, but thank you for saying that. So tell me, if you don't mind, what was difficult about trying to do it yourself? Because you live in Oregon, right? Mm-hmm. And you were trying to buy in Ohio. So what did you learn in that process of doing it yourself?
Is it hard? It's just hard to know where to start. I just booked a ticket to Dayton, Ohio, and met with, I think, 5 agents and 3 property managers and a couple lenders while I was, local lenders in the area. And you come away thinking it's just kind of a whirlwind, because you haven't actually worked with these people. You've interviewed them. So do they interview really well, but they don't do a really good job? So I've gone through one property management company there. I'm on a second one, and they're doing okay. That, it's not amazing. But yeah, it was very tough. I'm trying to diversify out of Oregon. So that was the reason that I went there, and looking at Florida and some other markets too. But, it's just nice to have. I'd rather spend my time analyzing deals or getting the financing, the financial stuff that I'm really good at, rather than the boots on the ground vetting property managers and builders. Which I love that you guys do that. It's really nice.
I love what you said in the pre-interview is like, what an interesting model to have crowd-based real estate. Is that what you said?
Mm-hmm. Yeah.
And that I had never really thought about it that way, but that's what it is, because these teams that we refer people to, if we get poor reviews from our members, well, they're not going to be on our list anymore. So it forces them to be great and to take care of our members. So I really appreciate that perspective. They work so hard at doing that. And I sometimes, very rarely, because I need to be in a really good mood and feel really strong, but sometimes I'll do a Google search on myself. And recently I saw something on Reddit that was like about us, and someone's like, oh, I met them and, not impressed. I'm like, oh my gosh, I wonder why, what did I do? But they also said, what do you need them for anyway? Just go do it yourself. And I so wanted to respond and say, yeah, do it yourself. And also know that there's this group of people who have a great track record. That's the benefit. But anyway, it's hard to understand that until you've done it. And there's a lot of do-it-yourselfers. It's just, and do-it-yourselfers are just that. They're good at that. There's people like you and me that would rather not, right? Rather pay someone else to do it. Just like I'd rather pay you to look at my portfolio and help me. It's the same kind of idea.
Yeah, that's a really good point. And that's not just in real estate. That's a decision we always have to make, whether we do something ourselves or whether it makes sense for us to hire it out, pay someone else to do it. If if it's a lifestyle that you want, that you love going into a home and, Chip and Joanna Gaines in it to death, like really renovating a place, BRRRR strategy, bring in tenants. If that's what you enjoy doing, don't use Real Wealth. Why would you do that? Because that's what you enjoy. I enjoy financial planning. I enjoy time with my family. I enjoy investing a lot, but that's at a high level. I don't enjoy getting down into the weeds, at least not anymore. When I first started, I was helping to renovate our duplexes and things like that. But you move past that, and I didn't enjoy it. That was to learn what I needed to know. But some people enjoy it. That's in anything. Like if you're going to fix your own car, if you really like fixing your own car, go for it. I don't like that. So I have somebody else do it. I'm putting solar panels at our house. I'm really enjoying it. I'm not going to hire someone else to do it. I'm doing it myself. Yeah.
Oh my gosh.
It's one of the best. I'm having a blast doing it, which is, I wouldn't have told you that I'd be up for doing something like that. But that's what people have to decide. So, that reviewer on Reddit, that's great for them. Don't hire them if you can save money or you think you can do a better job. Yeah. But if you have hundreds or thousands of investors that are vetting these providers, it might be hard to do a better job than that.
Yeah. Yeah. Agreed. Oh, so good. I know we're just about out of time. I'm just going to look at my list of questions to see what I might have missed. Okay, let's talk about this. This is a question that comes up a lot. Is there an age limit to investing in real estate? Because I know that that's been a thing for financial planners saying, oh, by the time you're 60, you really need to be in conservative investments, maybe even younger, I'm not sure. But we have a lot of people that come to us later in life because they are maybe liquidating, a property that they had in California that they can sell for $1 million and they can get into 5 brand new rentals in Florida or something like that. And maybe they're 65. I mean, we've had people in their 70s and 80s even doing that, increasing their cash flow. What are your thoughts on that?
Yeah, I would say definitely no age limit. Real estate, just like a lot of other investments, you can dial up the risk or dial down the risk, just as pretty easily within that asset class. So with real estate, and this depends on how you look at risk too. Like maybe you put 75% down on a property and you only take a 25% loan because you just want to have this little tiny mortgage payment that is not a big deal. You're 70. And if something happens where there's a tenant out for a few months and you have some cash reserves that you can pay that, it's not a big deal. Or you can just pay it with your Social Security check to cover that mortgage. Or you pay all cash for the property to reduce the risk. And now I will say, you have to be careful in thinking about risk. And what I've seen, especially in this market, is if you pay all cash for a property, I would say there's actually some more risk there than you might realize. And I think you've talked about this on this show with other guests before too. But the fact that you can get a 30-year mortgage for 2.9% right now, or as an investor, 3.5% maybe on a single family home, and you can take that $150,000 that you would have put to pay cash for it and keep that in reserves, or maybe get another one like you said, if you sell a property in California and you get a few nice loans on a few other properties that cash flow, you're paying down the mortgage, getting depreciation. I would argue that having all of your cash locked up in that property, there is a different kind of risk to that you do need to be careful of. You might not want to do that with all your properties, even if you're 70, even if you're 80. It's okay to have a mortgage. If you have a big chunk in the bank of reserves that you can pay that mortgage off for 20 more years and you're 80, I think you're going to be okay. It's all about reserves, right?
Yeah. It's good property management and reserves. Even in our own single family rental fund that we have, I was really nervous about getting leverage on that because, you got to make those payments. And when you're talking about a $5 million payment, loan, it's different than a $100,000 one, right? You got to be able to make those payments. So we just did what you said. We kept plenty in reserves, but we also had some of the portfolio in cash so that if anything happened, we could just sell that one property and, we've got the cash, or invest it in short-term lending or something like that. So I do agree that regardless of age, you could be 30 and it's a huge risk for you if you don't have the reserves, but you bought a property and it's vacant for a couple of months and then there's repairs that are needed, which there always are. Don't think that there won't be. You don't have that money. It doesn't matter how old you are. It's a horrible situation.
Yes. Yeah, definitely. The reserves will make or break a real estate portfolio. That's a big deal. And we're at a weird time now where inflation is outpacing these loans that you can get on properties. And that's not always a typical scenario where you can get a loan with a lower interest rate than what the actual inflation numbers they're coming out with. If you want to look at what inflation might really be, you're probably doing even better. But if you can get a loan for 3% and inflation's at 5% right now, the bank is paying you to have that loan. It's kind of becomes an asset to you in the long run.
I'm so glad you, again, brought that up, because so many financial planners and just conservative investors believe you should pay off your primary residence, when in fact that's where you can get your cheapest money, right? So if you refi your primary and get that 2% loan or whatever, and reinvest that, of course you need to know how to reinvest that properly. That could be a really good use of money. I mean, do you see any issues with cash out refinancing your primary?
It really depends on someone's situation. I don't. I think, so personally, or for for a client that's very responsible with money, has good savings, has good reserves, I don't think there's anything wrong with that. It is the cheapest money that you can get. It's incredibly cheap. We're the only country in the world that has these 30-year loans that you can get at these low interest rates. It might not always be the case. And the other thing that I should say is that it's not always that way. You look at different decades, it doesn't always make sense. What I'm advising clients to do now, 10 years from now, it might change depending if interest rates are a lot higher, if they need to refinance for some other reason, or say they are buying a house and interest rates are at 8% now. It might make sense to pay that loan down faster because you're getting a guaranteed 8% return on paying that debt off, and say inflation is about the same. So it's not a blanket statement for all times, but where we sit now with these just historically low rate loans that are available with inflation outpacing it is very unique. And it is, if you have the reserves, it's actually a very good hedge against inflation, which reduces your risk. Because if you have too much cash not working enough for you, inflation is going to eat away the value of it. And if you can put a loan on a property that cash flows very well, this is not speculation. These are investments that cash flow, then it helps hedge against inflation, which is a very big risk to retirees, especially if you have fixed income. Yes, you can really be hurt if the cost of food doubles in the next 5 years and your retirement income does not.
The cost of everything doubles or triples.
Yes.
I mean, it's accelerating. Okay. And then finally, is there a point where one might be not diversified enough and just own too much real estate?
Yeah. So real estate, it depends on the person, whether you can say you have too much real estate or not enough real estate. I would say if someone's very heavy real estate focused, you understand the industry, that's what you want to be invested in. I would say it's more about making sure you're diversified within markets, because if you are too heavy in one market, that can really hurt you. I would also say that there's benefit to the liquidity of other types of investments. So if you're investing in a 401k, a Roth IRA, traditional IRA, even precious metals like gold and silver, there's different benefits to those, that it is good to have some of those other vehicles, especially like Roth accounts that are not, you pay the tax now and you never pay tax again. I think that's an account that's going to go away eventually. And if you can take advantage of those accounts, max those out, I would definitely recommend doing that. If you're really getting into real estate investing and buying more properties, it's not too much trouble to max out your Roth IRAs too. And I've seen where clients, that liquidity, that future investment liquidity from those accounts affords them the ability to buy a property, and pull it out tax-free. Whereas if you pull it out of a 401k or a pre-tax account or sell an investment, you might have to pay tax on it without 1031 exchanging it. But a Roth IRA account, if you've got 100,000 in there, you can pull it out and it doesn't mess with your taxes at all.
Fascinating. Okay. Well, I'm sure if we could take live questions, we would get a lot of them, but we've already taken so much of your time. So thank you, Kyle, so much for being here on The Real Wealth Show. It's been really, really enlightening.
It's an honor, Kathy. Thanks for having me. I appreciate it.
And thank you for joining me here on The Real Wealth Show. You can go to realwealthshow.com to get access to webinars. There's over 500 that go much, much deeper into the mechanics of real estate investing, including interviews with CPAs who can really help you structure things and save you a ton of money. We have property managers who will teach you what to look for in property management. They teach those courses and those webinars. We have mortgage brokers who will show you what to really look for in a loan, especially when it comes to investment property. And then we have teams across the country that are over 57,000 members at Real Wealth have been working with and can give us great feedback on how they're doing. And they're on our list because they're doing great. and they can help you acquire investment property with property management in place in really hot growing markets like Florida and Texas and North Carolina, and then of course great cash flow markets like Ohio. So again, you can go to realwealthshow.com. It's free to join, and you'll get access to all of those in-depth webinars. Thanks so much for joining me here on The Real Wealth Show, and we'll see you next time. Bye-bye.
The views and opinions expressed in this podcast are provided for informational purposes only and should not be construed as an offer to buy or sell any securities or to make or consider any investment or course of action. For more information, go to realwealthshow.com.